Hello everyone, this is Okane and I'm going to talk to you about moving averages and their multiple uses. It's a must-have tool for all kinds of traders, regardless of whether you are short-term or long-term trader. So the moving average stands for the movement of the price, hence moving, and the average is the average data, average statistics that it gets from the candlesticks. So basically the movement of the candlesticks is translated into this moving average line. So let's take a look at these different kinds of moving averages. So in MetaTrader 4 you can go to Insert, Indicators and Trend and find the moving average. Now here you will immediately see there are various choices that you can make. For example, the period. The period means represents each candle. So if you use a 200 period, that is 200 candles. So for example, if you're on a daily chart, the 200 EMA represents 200 days because each candle is what? 1 day. So 200 period is 200 candles. If you go to the hourly time frame, then the moving average represents 200 hours because each candle represents 1 hour. So before we move on, let's go back to the rest of the choices. So that was the period. The methods, there are 4 of them, as you can see, the short, the nickname. So simple moving average, SMA, exponential moving average, EMA, smoothed moving average, SMMA, and finally linear weighted, WMA, moving average. Okay, so the MA stands for moving average. And lastly, what should the line apply to? What should the data be applied to? And most traders use the close of the candles. That's where the price closes, because it's good for history. When you use price action like support resistance areas, you want to know where before the candles close, where exactly and how did they close. So this one is the mostly used choice. So let's plot a 200 moving average, and the EMA relies and puts most weight on recent price. Okay, recent candles, it's what it weighs more on. Okay, so the data, what it plots here, based most on recent price. And the next method, which is the smoothed, we'll get back to the simple one, but now the smoothed moving average. I want to talk about this because this one is basically useless if you understand the connection it has between the EMA. Okay, so there's a connection between the EMA and the smoothed moving average. I will show you. I've already written it down here. So look at this. The SMA equals x times 2 minus 1 EMA. Okay, so that means that you can take any SMA level x, call it x, any level of SMA and turn it into an EMA. So that means that you only need one of them, and you can just use the EMA because the commonly used one in most strategies, and it will make the SMMA useless. Okay, so for example, you can turn, now let's say someone tells you to plot a 50 SMMA, sorry for the mistake there. Let's not confuse this with the other one. So turn the 50 SMMA to EMA. So how do you do this? You can either just plot a 50 SMMA like this. Let's do this just to see what happens. And then now we know based on this formula that 50 times 2 minus 1, that's also a 99, that equals a 99 EMA. So now let's plot a 99 EMA, see what happens. We already have one here, let's just make it a 99. Now you see it disappeared, but actually it's right here. It's right under our SMMA. Now you can see it here. If you go to indicators list, you will see we have two moving averages plotted. One of them is the EMA, and the other one is the SMMA 50. See, level 50, and the moving average is level 99. So if we remove the SMMA, let's remove this, see what happens. There you go, now your EMA is back. So you saw the connection there. I hope you understand what this means. It means that you can just neglect the SMMA and just use the EMA like every other trader does, because they're basically the same thing. All you need to do is to take it times 2 and then subtract one period, and you will get the same thing with an EMA. So that makes it useless. So now let's move on to the other ones. You also have another two methods left. The simple one also pays attention to recent price, and the weighted one, I haven't seen this being used that much, but you can plot one just to see the differences between the other ones. For example, now we have one EMA 99 and one linear weighted 99. So you can see the difference here. Now if you switch between time frames, you will see the difference. For example, if you go to the daily charts, here's where it gets more noticeable. For example, if you go to the daily charts, you see the EMA 99 is well adapted, well fitted to the tops of these candlesticks, acts as a good resistance, shows the trend is down. But the linear weighted moving average with the same period, it's kind of in the middle of the candles. It doesn't really act as either support or resistance. So that's why I prefer the moving average. The EMA. Okay, so now you understand the differences and what the period stands for. Again, the period is the number of candlesticks. So which levels, which periods should we use? For example, if you like to use support and resistance in your analysis, basic price action, like for example drawing lines and confirming those lines with your moving averages, then I would prefer the higher period moving averages like the 200 and even a 99 moving average, for example, is a good help for price action. You can see this how price acts as resistance, or for example here it's acted as resistance, or how it acts also as support. For example, if you go to a lower time frame, you will see how it acts as support. And also another thing is the distance between the moving averages. Any moving average you plot, regardless of the periods you give them, you choose, you will have a distance between them. So the distance tells you the distance between them, and the distance between the candlesticks themselves actually will tell you about the strength of the trend. So the more the distance, the stronger is the trend. Now this becomes obvious when you go to a lower time frame, and you will see that in this area price got very close to the moving average and then it crossed it. But the higher low here, this higher low, was with a great distance to the moving averages, to both of them actually, and the trend was stronger, and you had a secure call trade here at this position, at this entry, but not here as it crossed the EMA downwards. So this is another confirmation, this is another use for the moving averages. The distance tells you a lot about the strength of the trend. And if the candlesticks are above, then obviously you're in an uptrend. If the candlesticks are making lower highs below the moving averages, like this, like in this case, lower highs below the moving averages, and the distance is good, so you know the downtrend is strong. And then when the trend moves, the EMA, the lower period EMA, will cross above the higher period EMA, which is in this case the 200. So the 99 crossed from below, above the moving average with the highest period, and this signals a call, a bull trend or a call option. And when the distance gets greater and the candlesticks also get some distance from the moving average, you have a good signal, a good strong upgoing trend. So again, the opposite is true for the downtrend. When the moving average crosses the highest period moving average, the lower period crosses the highest period moving average from above and down, you have a downtrend. So the cross, the distance, and the price action, those are some uses, and the trend, obviously, those are some uses of the moving average. And there are other uses, for example, the breakouts. Let's also take a look at that. If we remove one of these, you will see here you had a breakout. Okay, let's zoom in. See this clearly. This candle closed above this EMA 99, so this is a breakout, and then comes down, gets support, gets pushed up. You see this by the candle wick. So you see this EMA is acting as support. So this is a breakout that you can trade. So there is another way of using the moving averages. But there are other ways. For example, the moving average can also be seen when you use a Bollinger Band. If you plot a Bollinger Band, it asks for a period. For example, if you use a period 50, that's the middle line. And it tells you, and it creates a channel that tells you where price is trending. For example, if you between the lower and the middle band, you get a channel, a bearish channel, and between the middle and the above line, upper line, you get a bullish uptrend, a bullish channel. So that's another use, the channels. And so how many uses have we had so far? Let's go through them one more time quickly. You have the trend, whether prices are above, making higher lows and higher highs above the moving average for uptrend, or making lower highs and lower lows below the moving average for a downtrend. And if the price is ranging and the moving average is between the candles, you don't have any clear highs and lows, and moving average is like crossing this ranging price, you don't have a clear trend, so you know you have to be careful when trading. So that's 2. Number 3 is the EMA crosses. For example, on the lower time frames, you can use a different period, a lower period, for example, a 50 and a 21, for example. Those are common values. So the crossovers, as I mentioned before, that's the third confirmation, the third use for moving averages. When they cross, the lower period usually crosses either the higher period from below and up for an uptrend, or from above and down for signaling a downtrend. Now in this case you have a nice uptrend here until it got broken. So that's why it's important to complete the moving averages with one more indicator. Don't overdo it, just use one more indicator and try to learn support and resistance, because in the end it all comes down to support and resistance, because all indicators will give you false signals, but with the help of price action, support resistance, understanding of the support resistance is going to help you more. And preferably you can add a stochastic or RSI to find out about oversold, overbought period levels. So use the moving averages in addition to other strategies, other indicators, and your own technical analysis to complete them. And Again, remember on the lower time frames, you might want to use lower period moving averages because a 200 is not going to give you that many crossovers, that many signals on the lower time frames, and but they're better on the higher time frames for giving you more exact price action areas, more exact support resistance areas. Like in this case, you can see this very clearly. If we remove this, you see how this area has become resistance, right? Thanks to the EMA 200 here showing us, confirming the resistance here. And before that, the distance showed us there was a nice uptrend and then it became resistance. So that's how you can use the moving averages. And as for the strategies, I suggest you take a look at, for example, the Guppy system. You can find this on binary options.soc.com. Just go to the website. There you go. So the Guppy system, recommended for beginners. As you can see, it uses 13 exponential moving averages, and that's all there is to it, but you can add your own favorite indicator to it to just make it make more confirmations, because the 13 moving averages don't count as 13 indicators because they are all moving averages. So you can add another indicator if you like, for example, a stochastic oscillator or a relative strength index to get more confirmations. And you can try this on a demo account, see how the moving averages give you signals. Read this article and learn, and that's a good start. So also don't forget to check my article, Moving Averages, a must-have tool for all kinds of traders. You can see it on binaryoptions.soc.com. And let us know if there's anything more you would like to learn. Comment, share, like. I will see you next time.